The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen. Lovely to have you with us this evening, and good morning to our friends in Australia. And I guess 12:30, good afternoon to our friends in New Zealand. How's the sound, folks? Can you all hear me all right? Just type in the questions box, would you? Let me know how it is. Okay, Eric, just landed in Brisbane 3 hours ago from Dubai. Good Lord bless you, sound is good. I hope we're going to see you while you're over here, my friend. Scott says in New Zealand, sound is good, Chase is good, Janet's good, Kevin's good, everyone's good. Okay, sound is good. Well, thank you for being with us. Eric, shoot me an email, let me know your movement so we can get together while you're out here. Would be grand to catch up with you. Weather in New Zealand is not so great. Hello, Pete. Pete says he can all hear us over there. So welcome, everyone. Lovely to have you with us. Got all of our usual friends with us here. Let's see. Oh, my goodness. Hey, Toddy's with us. Hello, Toddy. Over there, Adrian's new guy. He's going to be doing a tutorial soon. Alan's, lots of Alans. Alan Varian up in Brisbane. Hello, mate. Albert. Yes, hello, Albert. Good to have you with us. And Alex. We've got a big turn up today. Brian up in Wee War, thank you for being with us and thank you for your email. Brian, I found out about Black Stump Road because I found it on the way home. And as you say, that was a much better way to go. Much better way to go. Okay. Anyway, as you say, it's some great country out there. It's certainly worth seeing, isn't it? Wonderful out on the Liverpool plains there, marvellous country. Harold, a gold bug. Yeah, I know you're a huge gold bug, my friend, so thank you for being with us. I hope nothing I say today will offend you. Harold, you know, we're always only interested in everyone's welfare, but sometimes I like to give an alternate view. Janet, hi to you. I hope your ankle's recovered. Johnny down in Coffs Harbour, good to have you with us. Justin and Hank, I'm sure is around somewhere down in near Scone there. Kevin's, Mark, yeah, Mark Lutz, he's going to be one of our star traders. We're going to have a couple of these tutorial guys, Mark and Marilyn and Mike Murphy, lots of people here who are doing, hello, Albert Alan over in Florida. We're going to have a couple of these tutorial guys on in a couple of weeks, so you can have the opportunity of getting their views on trading time. It's pretty interesting. It's quite revolutionary, actually. And Tom over there in Florida, I must say, Tom and his firm are wealth managers, not brokers. I got chastised for that. Vicky's with us. Lovely to have Vicky with us. We love to have the ladies. We don't have enough of them. And thank you for all being with us today. Okay, let's get moving. Here we are. Rose, we've got Rose. There's another lady. And Marilyn, of course. Marilyn's up a bit north of me here at the Gold Coast in Queensland. Janet, trading time makes me 500 per day to start. Good on you, Janet. I wanted to talk to you. I tried to ring you the other day. You were out. I'll give you a call in a day or two. And Matty down in Melbourne. Hello, mate. Good to see you. About time you took a trip up here, or I took a trip down there and caught up with everyone. Yes. Lots of interesting people. Great to have you all with us, folks. Let's move on. I want to talk to you today about this issue of gold to own or not to own. And I was, my ire, angst, antagonism was spooked by the usual article. They seem to get them into the financial papers every week or better on all of these arguments about owning physical gold. Now, there's a huge industry in owning physical gold, and it's all rather interesting. I'm going to talk to you about that today, and lest you think that I'm only having a crack at owning gold, I'm certainly not. I think there's a much more insidious and powerful industry that's much more damaging, and that's the health fund, that's the stocks and shares, the retirement funds business. And I'm going to talk to you about both of those today and hopefully shed a little bit of light on them. So let's move on here and get started. Just make sure everything's working. We're recording all right. A lot of you coming in late today. Good to have you with us, folks. Terrific. A lot of people still coming into the tutorial webinar, I should say, and Bill Ford over there. Hello, my friend. We've got a terrific crowd of people who've been with us for a very, very long time, and of course, we always are interested in new arrivals. Do make yourselves at home. You're most welcome. So let's move on. Markets are rational, orderly, sometimes predictable. Lots of things happen in the Danieloode universe the rest of the world doesn't see. And I wanted to start off by showing you again Needham's heresy. And let's make sure your slides are changing. Yes, they are. And these are some points that I firmly believe in and can prove. But you've seen this slide before, but I repeat it simply for the purpose that it's so contrary to what everyone else thinks and tells you. And in the process of running the business and doing tutorials in particular, I speak to quite a lot of people. And some of them have very similar stories. One of the things is that the people who come to me have very often been to other people in the industry, other so-called experts, and they're disappointed. And they say such things as, so-and-so, I don't use any names here, I'm sure all the other people in the industry are trying their best, say, oh, don't overtrade. You know, you should only have X number of trades a month. When you learn the Danieloode, there's no such thing as overtrading. In fact, once you get to the stage of trading time as opposed to price, you get trade signals every day. Doesn't mean your trade gets filled every day or elected, as we say, but you get new time signals every single day. And it doesn't need to be anything too exciting, folks. You can do this on any computer. You don't need any great big data sets. You don't need any flash and expensive computers. Any basic computer will run all of the Danieloode stuff for you. And those of you who haven't yet taken the opportunity, I'd love to teach you how to become financially independent. Let's move on. Physical gold, the story, huge business. As Harold's an expert at it, he's a big-time gold bug up in Redding, California. Lovely bloke. I have the pleasure of meeting Harold and some of his other friends up there when I did a tutorial there many years ago. Seems like a lifetime ago, Harold, and the Danieloode moved on so much since then that it's practically impossible to recognize it. But I did do a tutorial up in Reading and met some great people. Harold very graciously had us to his lovely home and entertained us, and I really did enjoy meeting you, Harold, and your friends. So Harold's a big-time gold bug, and nothing I say here is derogatory to gold bugs. If that's your thing, that's your thing. We all have our little particular foibles. Mine is rugby, and at the moment also the America's Cup. Those of you who are not yachties might not even be aware there's a yacht race going on in Bermuda between America, USA, Oracle Team USA, the holders of the America's Cup at the moment, and a number of challenges from Great Britain, Japan, Sweden and New Zealand. And New Zealand's got its way through to be won the preliminary round. It's now the challenger of record, and we're into the finals of that racing. It's not really real yachting that you would recognize. It's since Larry Ellison got hold of the America's Cup. He's been very entrepreneurial. He's turned it into a real visual spectacle. They're racing these 50-foot catamarans that have foils underneath them, and they jump up out of the water and fly along on these fly on these foils underneath them. Quite extraordinary. Scott says, "Pray for us, John, for America's Cup." Yeah. I'm wholly invested in that, Scott. But anyway, so Larry, being Larry, took a 144-year-old tradition, tossed it all on its head, and went from large monohull, single-hull sailing yachts, which most of you would recognise, to catamarans with these foils underneath them, reduced them to 50-footers. And these things do about up to 40 knots, which is like 50, 55, 60 kilometres an hour, maybe 30, 35 miles an hour. Quite extraordinary going upwind. I'm a yachty. If you're going upwind in a conventional boat, certainly of the size that I've sailed, if you can get 8 knots out of them, equivalent to about a bit less in miles per hour, you're doing very well. These things are doing 30 knots upwind, quite extraordinary, and a huge spectacle. They're not it's not really real sailing, but it's a real spectacle, and it's being televised. American channels have got it as well this weekend. The score so far, there have been 4 races. New Zealand has won 3 of them. It's first to 7. New Zealand's actually won 4 of them, but they only get 3 points because Oracle started off with +1 for winning one of the round robin series. Anyway, it's on this weekend, folks. America's Cup sailing. Have a look. It's pretty exciting. Okay, so physical gold, this is a real big retail industry. We know the wholesale part of it. We understand that. We understand the production side. In the retail industry, these are all the people that, well, not all, but the ones I could think of who are involved in it: bullion dealers, miners, bullion banks, depository services, private investors, web services, salesmen, and always the spruikers. The guts of this industry is that it is constantly spruiked. The spruiking takes 2 forms. First of all, price suppression. There's a constant outburst of the fact that the big banks, maybe governments, anyone else they can think of, is artificially suppressing the price of gold. The other great push for gold is to try and steer people away from trading derivatives, that is COMEX gold or futures contracts, and to emphasize that that's just paper, and you've got to own real gold, physical gold. That it's a great store of value, that it can never be confiscated from you, that it's safe. We get all of these theories of conspiracy theories. We've got a few members who are very keen on conspiracy theories, some of which might well be true. The argument is, the government is devaluing your money. Fiat money is fake money, and not real money. Real money is gold. Well, of course, that's simply not true, but it's sprouted out again and again and again. It goes in line with what's on the bottom point on this particular page you're looking at. Always the spruikers. So I'm amazed how consistently these same old furfies get trotted out. The biggest one of them is that gold is real money. It's the only safe money that you can have, and that governments can do all sorts of nasty things to your bank accounts and everything else. Of course, that's essentially not true, and it remains not true because people either have short memories or are simply unaware of the recent financial history of gold. But since 1944, in Bretton Woods, New Hampshire, all the world's leading commercial countries got together, 44 of them, and they brought in what's called the Bretton Woods Accord. And part of that accord was that gold would be fixed at $35 an ounce and was wholly interchangeable between US dollars and physical gold at that price and that price only, $35 an ounce. Much of the hype about gold is that it has very limited supply, and that if there was a return to the gold standard, the price of gold would have to be many tens of thousands to be equivalent to all of the financial commitments that the world has made. But the real risk for gold, and you need to always remember this every time you see one of those articles, is the government pegged the price of gold, governments plural, I should say, led by the US, pegged the price of gold at $35 an ounce from 1944 until August 1971, when Nixon was the president, and they abandoned what was called the gold standard. So if the governments could fix gold at $35 an ounce for that period of time, they can certainly do it again at a different price. So don't believe the story that the value of gold is always going to be a free market. I'm sure in reality for our foreseeable future it will be, because gold is just not a threat to the financial system. But should it become a threat to the financial system, remember always that governments, if they want to, have the power to set the value of it. So this constant splurge of infomercials, I think they should probably be called, that gold is real money, that normal money as you and I understand it, which is fiat money, is not a source of wealth or value and is subject to confiscation by the government, etc., etc. The answer to all of that is so is gold. And the price of gold has been set in the past historically by governments and can be set again. So remember that just as the flip side. Stocks and shares also are a retail industry, and they, in my view, are a greater virus. I mean, I have views on viruses. I think the funds industry is a virus. I think Microsoft updates are a virus. There are lots of viruses we have to put up with during our lives. Some of them are beneficial, some of them aren't. And stocks and shares are a huge retail industry. Again, we know the wholesale part of it. We know the real capital raising possibilities of exchanges of publicly listed stocks. You see that every day in the States, that all of the bright young tech companies are issuing stocks all the time, and they're issuing a promise of future wealth in exchange for real money now. And that entrepreneurial boom and the technological innovation in particular has formed a huge part of America's wealth, in fact, international wealth. America are the leaders of it, but there are all sorts of other countries heavily involved in technology, technological innovation, disruption of established industries. And by and large, it's been for the benefit of the community at large. We think of all the wonders we have now with electronics, with websites, with digital newspapers, with digital banking. It's been marvelous, but the business of selling stocks and shares to punters, or the retail side of it, is very much, in my view, a con job. And these are the main players in the retail side of the stocks and shares industry. Issuers, they're the people who are issuing the shares, brokers who are spruiking them, the exchanges who manage it. And if you think of the hundreds or thousands, in fact, of companies that are listed on exchanges, very, very tiny percentage of them are actually there for the purpose of raising capital. That's been the prime purpose of going public, but very, very few of them are in a position to do that because their results just aren't exciting enough. Underwriters, they're the people who guarantee the value to the promoters who are issuing their stocks. Government support and government subsidies are a huge part of the stocks and shares industry, and no more so than in Australia, New Zealand and Europe. America hasn't yet been socialised or become as much of a socialist country as Australia, New Zealand and Europe, but who knows what the future holds. I think America has is probably the last country that has a really independent free enterprise streak. And I think it's a firm core of belief in the States, which has been overrun. In UK, Europe, Australia, New Zealand, we're really, to be honest, should be putting up our hands and saying we're socialist countries apart from the US. So those of you in the US, be really careful you don't follow down the same path, because it's not good. Institutional media commitment, same thing. If you can align the interests of the media with the interests of an industry, you get unlimited support. The financial industry spends massive amounts on promotion, and a very large percentage of that is going to established media, particularly the print media, who are hemorrhaging from the loss of the golden rivers, as they call them, cars, jobs, all those sorts of things that were exclusively advertised in the print media pretty much, and radio as well, but mainly the print media. That's gone. Innovation and disruption, those sorts of things now. If you're interested in buying a car, you probably look on a website. Same thing if you're interested in buying a house. If you're interested in a job, you're looking likely at a website. So those sort of the golden rivers of print have gone, which is why so many of the print media are in difficulties today. And don't forget, always the spruikers. To keep this retail industry alive, there's always spruikers for it. Now, just thinking globally of 401ks, in Australia and New Zealand, they call it superannuation. In other countries, there are other methods. And it all goes to the basis that if governments have an obligation to provide a reasonable safety net for their citizens, which all socialist countries, of which we're one, have that undertaking, then eventually the cost of supporting aging populations, and populations are no longer capable of work through sickness, circumstances, all sorts of things, it just becomes a huge burden on the state. Old age pensions alone, which are, on any understanding, very modest. Most socialist countries have old age pensions, as they call them, when you get to 65, which doesn't seem terribly old, particularly when you're sort of near that age or a bit more. They will give you a guaranteed pension, and the pension is supposedly in return for you having for you having paid your taxes and worked hard all your life. Well, that's becoming a huge burden on the state, which means other taxpayers. Remember, states don't have any money of their own. They take money from taxpayers and spend it as if it was their own. That now accounts for pensions alone is now equal to almost a third of GDP in most developed Western countries, which is just a huge burden. And that cost is rising all the time, particularly with aging populations, and the demand for pensions to have some relativity to CPI, Consumer Price Index, those sorts of general increases in costs that are going on all the time, although they're greatly understated in government figures. But there's some, the individual benefits. It's a very worthwhile thing, I think, to be saying to individuals, you should be looking after yourself. You should be saving for your retirement. You should be making provision for your family. You should support yourself. That's the first line in the mantra. And there are also community benefits if you have compulsory superannuation or savings schemes, that if it reduces the cost to other taxpayers, then it is a net benefit. The biggest benefits of all in this fabulous rort that governments have, probably inadvertently, I mean, I'm sure they all thought they were doing well. I think net, it's a good thing. It's a great thing, actually. But my God, the corruption and the benefits that flow from it are absolutely staggering. If you look at just the sell side of the industry, and funnily enough, sell-side analysts are not people who only advocate that you sell stocks. Brokers never advocate that you sell stocks. Their mantra is buy and hold until you die or go broke. But they're called sell-side analysts because they're the people who are responsible for promoting stocks and analysis, all of this huge industry of analysis of markets and individual companies and analysing their balance sheets. And despite the fact that less than 1% of that material is ever read, it's still a massive industry. And the European Union recently has been saying that, look, all of the big broking houses and sell-side analysts have not been transparent in how they're charging for this advice. And that's so, of course, that's just been buried in the transaction costs, in the brokerage, and it's a cost side. It's really a part of the marketing arm, isn't it? But the European Union's been pushing the big analysts, the big brokers, to put a cost on what they reckon it's worth. And Nomura's come out today, one of the biggest Nomura securities, and said they think they're going to charge $134,000 per client per annum per analyst. That's to talk to your chosen analyst. So you get a feeling for how many clients they've got and how many of them want to talk to analysts. You can see that this is a boondoggle of an idea, but it's been going on since time immemorial. They're really just promoters or boosters, and that sort of money, that's just pennies on what the superannuation and fund managers are getting. This is a huge, massive industry. The numbers are so big, it's very, very hard to get your heads around them. And predominantly, unions and banks get themselves in as money managers, particularly in our socialized nations, which is pretty well the Western world, minus the US. Governments decide who will be the managers. They have classes of people who can be managers. Now, in our part of the world, retirement is compulsory. Superannuation savings or superannuation schemes are compulsory. 9% is taken out of your paycheck every week, I should say, and it's directly remitted to your superannuation fund. And that is matched by an equivalent contribution from your employer. And who are these fund managers handling these fabulous rivers of gold? Well, they're largely trade unions and banks. So when the Labour Party, which equates to your Democrats in the US, when they're in power, they make sure the unions become the managers of these funds. And when the Liberals are in power, that equates to your Republicans in the US. They make sure that the banks are the managers, the default managers. And this is not optional. This is compulsory for all wage earners. And if you can just think of the amount of money and the vast majority of employees never get to choose who they want. They can, but there is so much detailed knowledge involved, and the mumbo jumbo of going through balance sheets of these hundreds and hundreds of super funds and trust funds are such that they just never get around to it. And so they just go to the default option, and the unions make sure that, or the Labour Party, the Democrats, make sure that the default option, wherever it can be, is a trade union. And the amount of wealth that they're accumulating is quite staggering. And they're actually not the baddies in this. Believe it or not, the baddies in this are the banks, the big banks. much the same all over the world, a little bit more so in our part of the world where the big four banks are protected by government policy. They're called the four pillars, and they can't be merged or taken over. They have a near monopoly position, and they're the dominant players in the management of funds. Tom, you'd be very interested in this, and they're very, very bad at what they do. In fact, the reality is almost everyone is very, very bad at what they do in managing other people's money. There are exceptions. Tom and his partner are one of those exceptions. They're very good at what they do, but they're not fund managers. They're wealth managers, which certainly seems to me a cut above. So what do the punters get? Now, this analysis I'm giving you relates very much to Australian companies because it seems to be a lot more transparent, although I got all this information from News Corp. That's Murdoch's business. He owns the Australian newspaper in Australia, other newspapers, the Sky Channel, the cable network. And you hardly ever see this sort of research published. For those of you in the US, the best place to find it is Morningstar. And some of this stuff comes from Morningstar. But you'll find that these results are pretty well universal. In fact, they're probably a bit better in Australia than elsewhere. And have a look at this. The top 10 super funds in Australia over the past 10 years returned about 6%. It starts at about 6.3, 6.4 and goes down from there. Top managers earn 20 million plus. Some of them are a lot of plus. And the great unwashed finish up getting a bath. Because why? When you start looking at the universe of funds, very, very few of them, less than half, make better than 3.5% a year over the last 10 years. Now, official inflation in Australia, New Zealand, most of this Western world, is around 2.5%, and that number's a great big fake. If you really believe inflation is 2.5%, let me know where you live. I'll come and join you. Real inflation, government inflation, has all sorts of things cut out of it, like the price of food. And in this country, where we have huge taxes on gasoline. Gasoline here yesterday is $1.39 a litre, and so it works out about $8 a gallon. Be a revolution in the States if that happened over there. But the legislation for these products is so complex that the benefit to those with knowledge is massively outweighs anything else. And few things in law are more complex than retirement accounts. Peter Credlin, who will be known to viewers in the Southern Hemisphere, a very, very smart lady, said in regard to the latest changes in the superannuation rules, the government seem to be tinkering with these things all the time. Few parliamentarians could even explain it, and that's right. It's an absolute boondoggle of regulations, and don't forget this is compulsory for all wage earners in this part of the world. Okay, so this is the article from News Corp that I got a lot of this information from. You find this very interesting. 1 in 7, these are Australian figures, that covers Australia and New Zealand. And they've only looked at, there's a total Morningstar provided these figures. They're analysing 346 growth funds in operation since 2006. 1 in 7 have made nothing in the past decade. Half of all share-heavy funds have earned less than 1% a year over that time. More than 150 of the growth funds tracked, that's 150 out of 346, so it's almost 50%, have not earned more than 3.5% a year. 33 funds have delivered average investment returns of 5% or more. That's only 33. That's less than 10% have delivered average investment returns of 5% or more. The 33 billion retailer employee fund, REST, this is telling you what the highest one is, earned 6.7% a year over the last 10 years. But have a look at these other figures. 150, or almost half of all these funds, have not earned more than 3.5% a year. Inflation in our part of the world has officially been 2.5% for the past 10 years. Take that off. In fact, realize that real inflation is many, many multiples of that. 2.5%, honestly, it's a joke. Your household, your domestic, go and ask your wife or your girlfriend or yourself, if you do the shopping yourself, what's happening to superannuation bills, what's been happening to automobile prices, what's been happening to house prices. All of these signifiers of real price inflation. They're not included in the official numbers. So if you've got the idea that this is a really, really bad deal, you're right. These things are essentially lemons. The amount of expertise and cost, talent as they call it, that goes into managing these things, it is extraordinary how bad the returns are. And really, that's a function of share markets. You come to the realization, and you'll see this more acutely in the States than anywhere else. It's the same everywhere, but it's very, very graphic in the American markets, that you've got those top tier of very, very exciting stocks that are technology dependent, disruptive to established industries, that they're the ones that are carrying the markets. Take them away and look at the financial growth, the performance of most of these businesses, and the reality is they're very modest. And that's why these returns are so modest. The opportunity for reward without commensurate risk is beyond these people. And that's the reality. So most of these products are lemons. Gold, as I put in the announcement to this, is itself a lemon. Gold made, I think I put the figures in the announcement for this. If you're simply relying on capital gain for gold, well, there are years when it's very good and there are years where it's not so good. But it certainly is not what you would call a store of continual income. So let's see if I've got that right for you. I think I gave you an example for this tutorial of what it would cost you to buy a decent lump of gold. They're only approximates. I'm not a gold bug, and I'm sure Harold will tell me my figures weren't quite right. But basically, if you look at the last 12 months, you made no money at all in capital appreciation on gold if you had to own it, insure it, store it, and that was the example I gave you. Stocks is what I'm talking to you about here. Really, on an inflation-adjusted basis, unless you happen to be in one of those top 10 funds, you've made very, very little. Half of them have made nothing. But these are the rules. When you have a dud product, what do you do to promote it? Sell, sell, sell. Get government support and subsidies, which the stock market has in abundance. Get media support by aligning the benefits for them with the benefits for the product. In other words, the stocks and share industry, massive supporters of media. They're promoting it. They have their tombstone advertisements, their promotions all the time. Brainwash the masses. That's what these constant blurb about stocks and shares. You got to own them. You got to own them forever. They always go up, never sell. Same thing with gold. Gold is real money. Government can't confiscate gold. Well, governments can do whatever they want to do. And the very best deal of all is to enforce participation, as has been done here. Sergey's asking, what's the view on cryptocurrencies? Cryptocurrencies are very exciting, Sergey. I wouldn't touch them with a barge pole. They're in a mad boom phase at the moment. They can go into a bust phase. And tell me overall, who are the people who are so interested in cryptocurrencies? Well, all the conspiracy theorists, all the criminals, all the people who are dodging tax. Why is it that you need to get involved in a currency that is What's the great appeal of cryptocurrencies? They can't be tracked. They're an anonymous way of having your wealth. Indeed, in most countries, particularly in our part of the world, I know in the US, if they want to do it, the government can see all of your accounts, your bank accounts. Nothing's secret anymore. Nothing's hidden, and governments are capable of looking at your bank account, your financial dealings anytime they want to. So what's the appeal of cryptocurrencies? That they're anonymous. I know the argument of privacy and government shouldn't stick its nose into your business. Look, I'm all for that. I'm a great believer in that. But the reality is that's not the world we live in. Governments have become more and more intrusive. If you want to live in one of the OECD countries, you have to accept the fact that governments have become more intrusive, and that's only going one way. Even with our own superannuation stuff, here's a comment from Terry, who's in Melbourne. Terry, good to have you with us. He says, well, superannuation is compulsory, so it's effectively a tax. We pay 9% plus 9% from the employer, a total out of 18%, and get a lousy 4 to 6% back. Well, that's right. That's right. But that's only us, Terry, not the politicians. They get 14%. Some of the academics get 14%. So lots of interesting things goes on with super. But anyway, when you've got a product that's a dud, what do? You plug the long-term and the never sell mantra. If punters were more aware of stock price movements, they would be a lot more skeptical of where their money's going, but they're not. It's the ignorance of the populace, the sheep, that lets this go on and on and on. That's why brokers, people who manage these funds, it's always the emphasis on the long term, the never sell, and obliterate the real risks. Great story for you. During the 2007 crash, one of our good old clients, Mo, some of you know Mo. He's been to a few tutorials in the States. He's a broker with a very large US bank, who I won't name. During the crash, Mo's clients were having heart attacks. And Mo was so thrilled when the low finally came. It was pretty much, I think he sort of thought it was the last week of his life. He'd been getting hammered day and night by clients. What's happening? Get me out. I can't get you out. On and on and on. And eventually the market made a low just where the Danieloode said it would, and when it said it would, and off it's gone. But the reality is, markets always recover for a number of reasons. One is inflation, the other is manipulation of the indices, which I've talked to you about before. But what if you needed to get your money out between 2007 and say 2010-11? The reality is, if you bought in the run-up to 2000, 10 years later, you lost an awful lot of money. But, never sell. If you can get into people's mind, always look at the long term and never sell. It's an excuse not to look at drawdowns, big multi-thousand point drawdowns in indices and other investments. So they're the real risks. Watch your timing. You might well need to liquidate your portfolio at a time that the market's down. Markets do go down. Not often, but it happens and it won't stop. And the argument with gold, think about what happened pre-Nixon. So they're the sorts of things that I really want to talk to you about. We have lots of gold bugs at the Danieloode. I know most of them. They're very decent people. Some of them are very passionate about it. It's your money, your life. They have their arguments, and those arguments to them at least make sense. And good luck to you. Folks in retirement funds and superannuation have the same arguments, and I respect that also. But you're not likely to get rich on it, bar government intervention, The gold is real money argument. I hear this floated all the time in quite respectable financial publications that, excuse me, I'm a gold bug. I'm a huge gold bug. I don't know who that is. I assume that's you, Mr. Red in Gold. I assume maybe it's Terry. I don't know. Anyway, this gold is real money argument says that as fiat money, what our normal dollars and cents are, it's called fiat money. I won't bore you with the detail of it. The argument by many gold bugs, or the more extreme of them, is that one day that system will collapse and that then governments will be forced to revert to the gold standard. And if you take all the world's liabilities divided by the amount of gold, gold goes to some unimaginable figure. Folks, it's not going to happen. It's part of the hold long-term argument. It's same as the never sell argument for stocks. I can show you plenty of academic research about what happens when markets go down, what that does to your portfolio. As opposed to all of that, what I wanted to talk to you about at this tutorial, again, this webinar, is the argument for active trading. We have this wonderful tool called futures. If you get really good at it, you can make more money than any other legal pursuit I'm aware of. For an active trader, it takes real knowledge, it takes real commitment, it takes real discipline. It can change your life. How often have I heard one of our tutorial people say, "You've changed my life"? One of the guys I'm going to get on for you in a couple of weeks who's doing a tutorial, I said to him just last week, "Mark, I know you're here, would you come on a webinar with me and talk to people about the experience you've had doing the Danieloode tutorial?" And he said, "John, you've changed my life. Of course I will do whatever you would like me to do." So this is real. This can change your life. Real wealth and sustained superior income will really change your life. And all you have to do is ask. And I'll be more than happy to show you how. Let's move on for a moment to the certainty of DC trading. There are two types of trading of financial markets. One is time and one is price. I wanted to take the opportunity to show you this chart, which you can now see, and this is actually a chart of crude oil, and it's the current front month. And I just wanted to show you some points on this. I'll just get the spotlight here because many of you have absolutely no idea how the Danieloode works. Here's the first bar. You can see I put the spotlighter underneath it. This is the bar of May the 25th, 2017. Have a look at the close of this bar. That's the little dot to the right of the bar, 49.14 against the Danieloode blue line of 49.06. These blue lines are published. If you've kept your charts from the past, you can see them on your charts. Then the market moves and it goes down to its next level. Right here, which we've moved on to May 31st, 2017, you can see it's being held up by one of the red lines. Now, I don't want to emphasize those too much because they're current lines looking at past prices, but look what it does to them. Move on, another couple of bars, you get 3 bars all being held up by that 47.08 line. Then you get the big breakdown. Here it is. This is the oil pushing down. This is June the 7th. Have a look at that low, 45.89. Why did it stop there? Because there's a Danieloode blue line at 45.75. And if that wasn't accurate enough for the market, which it wasn't, the very next day the market closes at 45.89. What the market is saying to you is, I know these numbers and I'm tracking them. 2 bars later, we get a close. Remember the qualification I've just given you on these red lines, but we get a close at 46.32. Where's the red line? 46.29. Now remember, there's 4,600 ticks available at this price. So you're talking a variation of a handful of ticks out of a possible 4,000. Market moves on. Now we get to this small down bar here, and we're all the way up to June the 15th. What's the low? 44.45. Why has this bar stopped there? Because there's a Danieloode blue line at $44.40. 2 bars later, if that's not accurate enough, where does the outside bar close? Close of that bar, which is June the 19th, is 44.43 against the DC blue line of 44.40. Okay, now where are we? Big down bar here, 42.05 against the Danieloode blue line at 42.14, and today an inside bar. Putting the Danieloode price delineations, the blue lines and the red lines, on charts trading price gives you certainty. Okay, more importantly than that, we'll go back to our normal tool here. John says, bugger, got to disappear from meeting. Catch up soon. Okay, old mate. Here we are. Let's move on now. And I want to talk to you. I want to give you a primer on trading time. This is the really knockout stuff. I've been working on this trading time for many, many years, but I've only actually started to teach it to people in the last couple of years. And it's quite extraordinary, which is why I'm going to bring some of our students on to tell you about it. The Danieloode ratios control all markets in both time and price. When you look at your chart, price is the x-axis going up and down. What's happening along the bottom is the y-axis. The y-axis is time. Trading price is a well-known and universal concept. Use those DC price levels. It refines the concept. But trading time is a relatively new concept. And time is variable and interchangeable. It's infinite, but we reduce the available universe of options to the known DC variables. And we can use time cycles from 1 to 89 in different time frames for different purposes. In other words, we always use the Danieloode ratios. And we use them in different time frames for different purposes. Daily trading, we can use time signals to create standalone trade signals on a daily basis. For our long-term forecasting, we use 6, 12, and 24-day charts. They're different purposes doing the same thing. And time trading, or trading time signals, is simply the vertical axis on the horizontal plane, which if you don't understand that, don't worry, because it took me a long time to work it out as well. But it's the same thing. Time and price are the same thing on a different plane. Here's a quick look. If we start at something fairly conservative, this is the 29-day time cycle. This is gold for the last 12 months. Now, we want to stick on gold. A lot of you are very interested in owning gold and being gold bugs. Have a look at this. These are the buy signals in gold for the last 12 months. This is using a 29-day time cycle. And you can see, hasn't missed any, has it? Let's move on. Let's look at the other side. I think we've gone past one chart. I've missed, here it is. That was the buy signals. Let's see if I missed one. Here I have. This is the sell signals. Sorry about that. It just jumped past the page. These are the sell signals. Have a look at them. Every high, every tradable high has got a sell signal on it. A couple of them you didn't want to know, but there's not many. And as you go further out the time spectrum, for those of you people who are interested in really long-term swing trading, these signals are just magic. And they're created purely by time. Those were the sells, this is the buys. And we can move down this spectrum. Let's have a look what happens. We're now starting to shorten the time spectrum. This is nowhere near daily signals, but have a look at these signals. This is gold for the year to date, 2017. If you got every swing, there's a potential 38,000 per one contract. Think about that for some money. Okay, so you're talking about something in excess of 70,000 a year possible if the present rate of volatility were to continue, which it doesn't. Volatility waxes and wanes, I know that. But this has been a year of dynamic volatility. Many other years are the same. So if you can capture even 50% of that, you are amongst the best 0.01% traders in the world. In fact, I don't know anyone who can do it. I haven't heard anyone say it's possible, except for our Danieloode students. And we have a substantial number of people who have been paper trading gold and returning $30,000 to $40,000 a year paper trading the Danieloode daily time signals. Now, I know paper trading's not real money. I have students say to me, I had one the other day, Sue, up there in Cairns. She's not with us today, but she's going to watch it on the weekend, saying, oh, I made $42,000. I think, don't quote me, folks, I'm coming off the top of my head, but it was something in the order of $40,000 trading natural gas for 1 year. I said, Sue, you've made it. This is a lady who's been to tutorials all over the country, who's been terribly interested in trading for 20 years or more, never done any good at it, had some wins, had some losses, and I said, you've made it. You're up there. You're in the top 0.001%. She said, oh, yes, but it's only paper trading. Okay, and yes, there are real problems. Paper trading is not real money trading. Real-time trading, you get different fills, markets, bars do different things. But if you can intellectually trade this stuff on paper and train your brain to be disciplined enough to put on the same signals, you will get substantially the same results with real money. And that's often the battle for many of our students, to have the discipline to train their brain so that they simply do their analysis exactly the same every day. And you can see here I put some X's across fail. I've written there on this chart. They're not fails as such. They're sell signals in an uptrend. Predominantly, a couple of them are buy signals in a downtrend. They're just bars that didn't give you a profit on the day. But I teach you that. I teach you how to manage those bars. With your skill of trading, you don't have to have the same risk profiles for all trades. You can manage your risk profile so that all of these ones marked fail either make you a little bit of money or lose you a little bit of money, but nothing dramatic. And keeping those losses managed and under control is a very, very big part of trading. And I want to just alert you to that, folks. So any of you who are with us who are new to the Danieloode, if you haven't had a free trial, you're most welcome. If you would like to have a free trial of the charting software provided by our partners, Genesis Trade Navigator, we can arrange that for you as well. All you need to do, go to the Danieloode website, www.thedanieloode.com, click on the free trials banner, follow the links. Any problems you have with your free trial or anything else you need, contact Terry at support@thedanieloode.com. And he'll be more than happy to assist you. Here's our compliance statement, folks. As I tell you often, trading is risky. In fact, it's very risky if you don't know how to trade the Danieloode way. If you have become an expert Danieloode trader, there is still risk, but you know how to manage and minimize that risk. Okay, let's have a really quick look at some charts. And let's start with our usual favorite. This is the S&P, very interesting stuff happening with markets. We said, a year ago, I guess 2,400 was the target. Everyone else jumped in. We're probably back about here, probably, where were we? I think it was probably 2016, may have been early 2017, that 2,400 was a target. We got to that target, as you can see. I'll just scratch this out a bit so you can see it a bit more clearly. Here we are. This was our 2,400. Got there, had a heart attack. It's now working on the next number here. which for your information is 2482. Now remember, these are not the Danieloode blue lines, which are available only to our members. These are an approximation of them, but they've been pretty darn good so far. I wanted also to show you what's happening with gold, seeing as this is about gold, and today's argument is about trying to get you to trade futures in gold in preference to these other ideas. And not just gold, there are lots and lots of markets. All of the commodities, I know futures are stuck in equities are stuck in their constant up mode, which is not great trading. We get the best trading when we have lots of vertical movement on the charts, and commodities, lots of them, copper, coffee, metals, gold and silver, the grains, US dollar index, wheat, you name them, we can go on and on. We actively trade 15 futures markets here at the Danieloode. This is gold. This is the weekly chart, which you've seen before. You saw the run up. We had a nice hit on the 1297.4 number in April, and then a pullback, and then another run up to test that number, and a false break. Now, that's what's sometimes called a double top. It's a potential hook for those of you who know what a Danieloode hook is. And Alan, quite right, as you say, can you do the US dollar since it affects gold? Yes, I can. And it affects gold big time. Let's see where we've got it. Here's the dollar. Now, gold and the dollar are inversely correlated, folks, and you'll see what I mean. I've said that on previous occasions. It may even be available in this chart. Let me see. Bear with me while I go to it. In here, let's go to gold. Here's gold, and let's. No, we haven't got it on this chart. Well, take my word for it, it's inverse. It is not always inversely correlated, Alan. It is sometimes inversely correlated. Here was the US dollar index. We had the bounce off the blue line in March 2015. We had another test of that number. Then we were looking for this resistance at 102,450. We had a break through that twice, and it's now sitting holding support quite high up. Is there anything to suggest that the US dollar is going to weaken dramatically? Nothing that I can see at the moment. It's been happily range trading since 2014 between basically 92 and 100 and, 102, I was going to say. In fact, it's been up as high as 103.8. I think it continues to range trade. It is actually quite strong. Tom would like to know about the NASDAQ. Let's see what we've got for the NASDAQ. I don't think I've got a trading chart for the NASDAQ at the moment, Tom. No, it's just straight up. What's really interesting is the way these futures on equities are diverging. If you have a look at the Russell and the Dow and the NASDAQ, they usually tend to be pretty uniform, if not in quantum, at least in direction, and we're getting some real divergence there. And that's the first sign of a fracturing market. If there's something specific, Tom, that you want to shoot me an email, and most of these charts are on a different computer than the ones I use for these webinars, so I can have a full analysis of the NASDAQ available for you at the next webinar. Okay, folks, I hope you've sort of got the message that there's a better world out there. You know, one of the great things about futures trading that's sometimes understated, rather than talking about huge wealth and huge gains, it's the day-to-day income. You know, what always strikes me is how quickly I have to put money back into my bank account. I keep a certain amount of money. You know, I have a wife and 2 teenage children. They all run off my bank account pretty well, and I'm amazed how much money disappears. You need a reasonably good source of income. The bigger the better. And the beautiful thing about trading, once you get good at it, you have a better assured income than you have from a full-time job, I promise you. It's your own life, it's your own management, it's your own skills that are generating that wealth. And it's a very, very worthwhile thing to pursue. So think about trading, think about having this stream of income that goes on for the whole of your life. And then you can teach your wife, your children. It's very simple when you know how, because over 30 years of finding the Daniel Code and researching it, I've reduced it to very simple rules. Once you know that, you have that wealth for yourself forever. You can pass it on to your wife, your children, pretty well whoever you like. But, be sensible. What we don't want is this thing getting out in the public domain, because then it becomes devalued. That's about it, folks. We're over time as usual. I thank you for being with me. If there are any questions you like, do. What would be the minimum US dollars to start? Asked Sergi. Sergi, you don't need a lot of money. If you have a $10,000 account, you can trade futures quite happily. In fact, depending on what you want to trade, you can look at the margins, go to Gain Capital Futures or the CME website, see what the margins are on futures. You can also trade Forex. Don't forget, I talk mainly about futures because that's what I trade. But I used to trade Forex for many, many years, still do occasionally. You can trade on Forex for much less. You can trade Forex off margins for about $200. You don't need a big bank to get started. What you need is the knowledge. So shoot me an email if you're interested. I'll be happy to call you on the telephone, talk to you about it. Akshay, any update on Nifty? Not really, Akshay. We did Nifty for years and years and years. We had a couple of attempts to push into the market in India. It didn't take off. It's a shame because the Daniel Code on Nifty is pretty fantastic trading, but we simply don't have a big enough clientele. We have a handful of clients in India, that's all. So it's not really worth our while running that. Any live tutorials or online now, David? Love doing the live tutorials. I haven't got anything scheduled at the moment. The last one we had set up, we found that 90% of the people want to do the video tutorials online. And I must say we're getting startlingly good results with the online teaching. I think that's because they're all individual sessions. It's just you and me. We record each of your sessions and put them on one of our secure servers for you. And you can review them again and again and again. With the live tutorials, as most people say, it's like having a fire hose of information jammed down your throat. There's so much stuff which is all counterintuitive. The Daniel Code is unlike anything else you've ever heard of in trading. It's not standing on the shoulders of giants. It is in an entirely different way. But what comes from the Daniel Code is entirely different to anything else you've seen or read or heard of. So you've got to train your brain to think in the Daniel Code way, which in many respects is counterintuitive. So I don't have any live tutorials planned at the moment. I'd love to do them. They're the best fun. I would do a live tutorial every month of the year if I had enough people who wanted to do it. But if you're interested in the tutorial, either a live tutorial or online, shoot me a line. We're doing online tutorials in July and August. So do shoot me a line and send me your phone number if you like. I'll give you a call. We can have a chat about any of your questions. Okay, folks, thank you so much for being with us today. Enjoy your weekend. For me, of course, it's Friday. Even though it's winter here, it's a beautiful sunny day. My son was in the pool swimming yesterday. Said it was okay. He's a lot younger than me. I don't think I want to go in today. But certainly it's just a short sleeve shirt weather down here at Queensland's beautiful Gold Coast. and it's gone 11:30 down here. It's 20 to 12 midday on Friday for me. So I'm near the end of my week, and thank you for being with us. Donnie Maydale, hello, my friend. Good to see you with us, and Mike Murphy as well. All great stuff. Look forward to seeing you soon, Alan, and others, and look forward to having you with me the next time we do another webinar, which normally it will be in 2 weeks. If there's anything really exciting happens, we'll stick one on at short notice and let you know. But at the moment, enjoy your weekend, and I'll look forward to seeing you and meeting with you at our next opportunity. Bye-bye.